In the last 50 years, stocks have outperformed all assets, including bonds, real estate, and commodities. The shocking thing, however, is that there are people who actually lose money while investing in stocks. When this happens, there are a multitude of excuses that present themselves, such as accusing the stock market of being rigged, blaming their supposed bad luck, or simply stating that the stock market is too risky. Wrong. Anything is risky if you don't know how to do it. For instance, if you decide to go swimming without learning how to swim first, it is definitely risky, right? You have a big risk of probably drowning. Similarly, if you decide to go for a drive and you don't know how to drive, you would most likely crash the car and hurt yourself. So in this video, we will cover 4 golden rules of successful stock market investing that will hopefully make your journey to wealth sustainable and a lot more consistent. Golden rule number 1. The stock market always goes up in the long run. In the course of time, you can never lose money if you invest long term because the gains from the up years outweigh the losses. The stock market always goes up eventually, and in fact, the stock market doubles every 9 years on average. If we take a look at the past 120 years of the Dow Jones on a graph, we can see that the stock market eventually follows an uptrend. However, many people wonder, what if I invest now and the stock market crashes? Then they'll say, I'll just wait till all the problems in the stock market disappear. No, because if we take another look at the history of the Dow Jones, there was always some or the other problem that persisted in the stock market. There was the Great Depression in 1929, then we had World War II in 1945. Next came the crash of 1962. The cycle continues through the dot-com bubble and 2008 until our current COVID-19 pandemic and its resulting inflation. In the end, the stock market always found a way to go up. The burning question is, however, how do stock prices always manage to go up in the long run? The answer lies in the concept of earnings. When we buy a stock, we are buying a small piece of ownership in a business or a company. The more earnings that a company makes, the more it is worth. Earnings will go up and down in the short term, but in the long term, they will always go up. Why? This is because companies will eventually raise the price of their goods and services. This is also known as inflation. At the end of the day, we realize that out of 71 years of the stock market, there were only 18 years of bear markets. However, there were 52 years of bull markets. To put this in perspective, we had a bull market 73% of the time. Golden rule number 2. Nobody can predict where stock market prices will go in the short term. Nobody can predict for certain where stock market prices are going, but we all must have looked at the news in the stock market at some point. Some people will in the news say that the market will crash 40% or even 80%. Others are more optimistic and say that the market will rebound and make up for its losses in the second half of the year, or maybe wind up with a big profit. Which of these perspectives are correct? Well, both perspectives are right and wrong at the same time. If we revisit our chart from earlier, historically, the optimistic perspective is right 73% of the time as the stock market goes up. This is because there was a bull run 73% of the time. However, when the market goes down, the pessimistic perspective is right 27% of the time. Thus, you never know when the stock market is going and where it is going in the short term because there are too many variables that play a role, such as the news and human emotions. This is also good because this means that we get to buy good stocks at a lower price. When the stock market goes down in the short term, many people say that they're losing money. However, as long as we don't sell, we aren't losing anything. As long as a company's profits are going up, the share price doesn't matter. I always like to say that trying to predict the stock market in the short term is like predicting the weather. Weather forecasts and stock market predictions are both often made on probabilistic guesses. We cannot perfectly predict human emotions in the stock market, just as we cannot predict the weather. Golden rule number 3. Never make investment decisions based on the predictions of experts, whether they are economic analysts or YouTubers. I always say that my videos are for entertainment purposes only. Additionally, never make investment decisions solely based on news headlines. As we have said before, stock market predictions are often made based on probabilistic guesses. We can never be sure where the stock market is going in the short term, and if we blindly follow the news and these economic analysts, we could hurt our portfolio to great lengths. A good example of this situation is that back in 2012, Goldman Sachs had recommended their clients to build short positions in the S&P 500 due to a weakening domestic economy. However, shortly after this prediction, the market went straight up 7%. A similar example is that on the 14th of March this year, JP Morgan made a statement that said that Chinese internet stocks were uninvestable and should be sold. 2 days later, those stocks went into double-digit returns. Yet another example of why we shouldn't make investment decisions based on headlines is this graph. This graph shows all the catastrophic headlines in the history of the stock market, such as Ebola outbreak fears, the US-China trade war, and the European sovereign debt crisis. The crucial question is, what happened after all these headlines? The answer is that the stock market went up. Your decision to buy and sell stocks should be entirely based on your own investment plan and not on the media's emotions. Golden rule number 4. Stock market declines are opportunities to buy. The stock market is just like a giant supermarket of stocks. It is a supermarket where different stocks are on sale every day at different prices. To clarify this idea, imagine that you are going to your local supermarket. You see good things that are on sale 40 to 50%. When you see this, you will probably be happy, excited, and buy those things. The stock market is just like a supermarket, except, as Warren Buffett likes to say, it is the only supermarket in the world where people run away from sales. This is because many people don't understand the true meaning behind buying the dip and the business behind a stock. Buying the dip is not about the share price falling, but it is about the company's profits and intrinsic value at the end of the day. If the company's profits are steadily rising, but the share price is falling because of something like news headlines, then the stock is still profitable in the long run. Why would we need to sell it? If we sold it, then we would actually be losing the stock's intrinsic value in the long term. However, an important thing to remember is that companies, for long-term investing, must be financially strong and must follow an uptrend in the long run in order for this strategy to work. An example of these stocks could be represented with the acronym of FANG. FANG stands for Facebook, now Meta, Amazon, Apple, Netflix, and Google. These companies have an economic moat around them because they are all dominant forces in their own tech industries. In the case of these stocks especially, any short-term dip in the market should be a reason to get excited and buy more stocks. Many people fear that if they buy the dip, it will dip even lower. Consequently, people think that they must buy the very bottom of the dip in order to make money. This is not true because ultimately the stock market will go up at the same percentage. It doesn't really matter if you bought a stock at minus 20% or minus 40%. In the long run, the stock market will still rise 400 to 500%. Let's imagine that I told you that if you buy a stock at $50 today, it's going to be $200 in a couple of years. You'd be very happy, right? However, what if I told you that this stock would first drop down to $27 and then go to $200? Would you still be happy? Of course, yes. That is, if you decide to stick around till the end. In conclusion, when we can understand the business behind a stock, there is nothing left to fear. That's all for today. Make sure to like and subscribe, and I'll see you in the next one.